So allow me to formally welcome you to our event today. We're really excited to be sharing with you the key proposals in the second exposure draft of INPAG, International Non-Profit Accounting Guidance, so that you can give us your feedback. My name is Samantha Musoke. I'm the IFR for NPO Project Director for Humentum. I'm based in Uganda, and many of you have received an invitation or an email from me. So thank you so much for your positive response. I'm delighted to be joined today by Paul Mason, who is a technical associate with CIPFA, the Chartered Institute of Public Finance and Accountancy. Paul has been responsible for drafting the content in this section 23 and is absolutely the right person to answer all our questions. So welcome, Paul. Thank you so much for joining us. We also have Philip Trotter from CIPFA, and possibly Karen Sanderson will join us later, and other colleagues from CIPFA as well. So you're all very, very welcome. Thank you. I hope that many of you have attended earlier events and have some awareness about the IFR for NPO project and INPAG. So rather than spending time in this short webinar introducing everything, we have shared a short introduction video. It's on the event web page. It was in your emails. And we will also share it in the follow-up emails after this webinar if you haven't seen it already, and it's on our YouTube channel. So please excuse us for not giving a lot of framing. We're just going to basically dive right into the content. So today's webinar is part of a series covering the main themes in Exposure Draft 2. You can register for future events, and you can view resources from previous ones from the website at the events page. It does take us a couple of days to get the resources up, so please give us a few days grace on that. And we are incredibly keen to hear your thoughts and feedback. The perspective of people working in the sector, as well as donors, auditors, the accounting profession around the world. It's really essential to making sure that the guidance is relevant, user-friendly, credible, and fit for purpose, so that it can be widely adopted. Now, even though this project started back in 2019, we've received input from experts and advisors to reach this point of having the exposure draft to share with you. So this isn't something that's been made up by a small number of people. It has had extensive exposure and consultation with advisors. But the purpose of today's webinar is to explain these proposals and for you to have the opportunity to ask questions and seek clarifications on the proposals being made, as well as share your comments, opinions, and feedback. And at the end of the webinar, we'll also tell you how to submit a formal response to the public consultation if you'd like to, and we hope you will. So the flow for today's session is here. We've already finished the introduction, and now we're going to do something a little bit unusual. We're going to watch a video on YouTube that we've prepared in advance to explain the proposals. It's about 17-18 minutes. So we're going to put the link in to a playlist that has the same video in English, French, and Spanish. So because we've got many languages represented, we're not going to actually show the video here in Zoom. I want all of you to follow that link and watch the video in YouTube in your preferred language. In case you get video adverts, Zoom adverts, I'm sorry about that. Just to let you know, this is nothing to do with us, and we don't formally endorse any of the products or anything that's advertised. Please just click through and so that you can see the video. I think the links have been shared there in the chat to the playlist. Is that right? Yes. It says English, French, and yes, there's a YouTube link, so you can follow it there. Now, as you're watching the video, please think about how the proposals apply in situations that you're familiar with in your context. Please type any questions that come to mind using the Q&A in Zoom as you go along. You can use the Zoom for English and the Microsoft Translator for any other language. Then after that video has finished, please let us know in the chat that you've finished watching it. We'll give a few minutes for everyone to finish. And then we'll come back together in Zoom and have Q&A and comments. Now, because of the size of the event and the time and language considerations, we will only take questions in writing, and we look forward to receiving those. So now, unless there are any questions or comments, some people can't see the link. Could you reshare the link, Brian? We will now go to Zoom. So I'm going to stop recording, and let us know in the chat if you have any problems. Otherwise, see you here shortly. Great, so welcome back. I hope you've had a chance to watch that video, and we've got some fantastic questions in the Q&A, and I'd like to make sure we have enough time for that. For those of you that haven't quite finished watching, sorry about that. Maybe you can enjoy the Q&A and then go back and watch the rest. So I'm actually just going to stop sharing so that we can see each other better. Great, there you are, Paul. So my first question, Paul, and this has come up, I should say to everybody, some of the questions will be from the Q&A that you can see in the webinar. Some have been submitted in advance via a form, and some have come from the earlier 2 webinars that we've had on the common model and grants expenses, but actually related to revenue, and we haven't had a chance to pose. So, and then there's obviously some great questions in the Q&A. But the first one I want to put to you, Paul, and this has come out in the comments here as well. This just feels really complicated. Like especially if the first time watching this, there's lots of terms, there's lots of new acronyms, and just the very process of the recognizing enforceable grant agreements seems quite complicated. Why make it so complicated? The idea is for this to be for small and medium entities. Please, can you speak to that?
Yeah, it's to an extent, it's like anything new. It always seems more complicated than it necessarily is the first time you see it. Yeah, it looks like a complex model, and there are terms that people won't have seen before, which make it more difficult to understand. However, we think that in practice, for many grant transactions, it will be relatively straightforward to apply in practice. I'm presuming we're talking here about the enforceable grant arrangements, because the OFAs, which is just recognised as soon as when you receive the cash, is easier. But for the enforceable grant arrangements, for a lot of grants, people will, or NPOs will receive a grant. There will only be one thing they have to do to be entitled to that grant, and therefore you recognise the revenue once you've complied with whatever that requirement is, whatever that EFO is. And that's a relatively straightforward bit of accounting. And for a lot of the smaller NPOs, where it's a straightforward grant, we'll give you $10,000 to carry out this activity. The only real decision is, well, do I recognise the cash when I've completed the activity, or should I recognise the revenue in stages up to that point? So it's not overly complex. As you get into more complex transactions, so you've got 2 obligations or 3 or 5, then yes, the complexity will increase at that point. But in terms of what you're accounting for, it's really how you should be managing the grant anyhow. If somebody has given you a grant to carry out 5 activities, and you're going to have to repay some of that grant if you don't complete it, then actually you do need to know how much, whether you've completed each of those activities anyhow. So yes, it can get more complex with more complex transactions, but for the simple transactions, hopefully it's not too complicated. It's really going to be down to the nature of the grant. And there are things that can be done to simplify that in the agreements. So if the agreements clearly set out the separate activities and how much of the grant relates to each of those activities, perhaps by the NPO, if it's making bids, having a detailed budget that says we're going to spend so much on activity 1, so much on activity 2, so much on activity 3, that will make the process of allocating the grant amounts to those activities much easier. So actually, by improving the grant arrangements with the donors, that can help keep the accounting more straightforward as well, and probably lead to better management of the grants too.
Okay, so the accounting is actually following the complexity in the grant agreements effectively. And if you've got simple transactions, the accounting isn't actually that complicated.
Yeah.
Okay. So there's a very good point here from Shane. His point is that it's complicated, but I think the crux of his question is, what's the value? What's the win? So there is a level of complexity of, splitting out a grant into its deliverables and assigning the amount and recognize the revenue as each thing is done. Maybe that could be made simple, but why? What's the value? What's the extra add that actually brings to the user of the financial statements?
It tells the users of the financial statements what the NPO is currently entitled to. So if you get to the end of a financial year, you're producing your financial statements, you've completed some of the activities, but not others, then at that point, you recognize revenue for those activities that you have completed, or impartially completed if you're recognizing over time. And that's revenue that the NPO is entitled to. That revenue can't be lost. The rest of the revenue is still at risk, because if the NPO doesn't complete those activities, it won't be entitled to that revenue. So actually what you're showing is the users of financial statements, how much has the NPO actually be already satisfied the criteria, is entitled to and can recognize as revenue, and how much does it still have to carry out activities to complete. So how effectively some of that revenue may still be at risk, work may still need to be carried out to do that. If you were to recognize all the revenue up front, you wouldn't be showing reflecting the NPO's entitlement to that revenue.
Right, so it's actually giving us a bit of an insight in terms of risk management. If, say, I'm a board or an external and I want to see what are the risks to the organization, I can see that in terms of unfulfilled obligations. If I want to see revenue that I'm entitled to but hasn't yet come, which could impact on a fund balance or anything else, I can see that as well.
Yeah, okay. And that's going to be useful for the users of financial statements, but also for the NPO's management.
Okay, so that's the win. So that's why this is why we've got this in here, complex as it needs to be, trying to keep it as simple as possible. So thank you for addressing that, Paul. I think those are really, really fundamental questions, and I'm sure we'll keep coming back to those. There was a great question in the Q&A about the contract. Well, no, first actually, let me do this one. Contract for services. The kind of 5-step approach that we've got which is taken from IFRS for SMEs, which is a bit, it's a bit like accounting for contracts. What's the difference between a contract that's for the benefit of the donor customer and a contract that's for the benefit of a third party or a society? Are they different? Why should the accounting be different or the same?
We're using essentially the same model for both. The difference really comes down to what you're required to do as the recipient of the cash. So we're talking about IFRS for SMEs, and at the moment, the ISB is, or it's issued an exposure after it's had comments back on an update to IFRS for SMEs, and it's proposing in that a new model for recognizing revenue from contracts with customers, which will again have a similar 5-step model to the one that we've been talking about. The difference is in when you're talking about contracts with customers, what the NPO or what the recipient of the cash, the provider, has to do for that is provide goods or services to the purchaser. When you're looking at NPOs and grants, typically you're not providing goods and services back to the purchaser. If you were providing goods and services back to the purchaser, then you'll be treated as a contract with the customer. What you're doing is maybe providing goods or services to third-party beneficiaries, maybe just trying to meet objectives, outputs. Maybe you're being given a grant to carry out activities for your own purposes, so training of your own staff. So there's a whole range of additional things where you might be receiving grant income, which go beyond what would be a contract with the customer, because there's no consideration going back to the person making those payments, the purchaser.
Yeah. I think that's what's been really interesting on our journey of sort of working this out, is that yes, some of these grant contracts really look very similar to contracts for services with customers. You know, they basically are the same sort of structure, just that the end goal is different.
Yeah.
And hence we've got the same accounting treatment. And again, this reflects the sort of complexity within the sector. It's easy to think NPO accounting is simple, but some of these contracts aren't. So that's really helpful. Now, I've got a great comment here that came in to the form online. It's from somebody in Latin America, saying that this term income and revenue, ingresos, I suppose in Spanish, is really sort of affiliated, associated with profit and for profit. And the comment is, why did you use that term income or revenue? Wouldn't it be better to use incoming resources or inflow of money or something like that, but not this term that is so wedded to the profit-making world? Why have we gone for the same term?
I think different countries use terms to mean slightly different things. So in some countries, income, revenue may be wedded very strongly to profit-making entities. In other countries, that's not quite the same. It's just how much have you received. So we look at other standards, international public sector accounting standards, the IPSASs, which apply to the public sector. Again, they talk about revenue, and that's a lot of that may be things like tax revenue, which is not the same as profit making. So it's a term that is commonly used internationally for incoming resources, not necessarily in a profit-making context. But when people are wanting to talk about that in terms of their financial statements, then if they feel a different term is more reflective of their situation, how the term is understood in their country, nothing to stop them using a different term in their financial statements. Okay, so there is some flexibility there. And do give us feedback if any of these terms really don't fit in your language, in the French or Spanish translations, or in English in your country context. Do let us know that as part of the feedback. And as Paul said, there's the freedom to change. That's always good to know. Okay, there's so many wonderful questions here. I don't even know where to go next. Let's go to this one, which is about match funding. I know in our sector, this is a really common thing. So let's say a funder has, the project costs 100, the funder's given me a grant for 80, with the obligation, if you like, if I can use that word, for me to provide the other 20 from other sources, match funding. And when I provide that financial report to the funder, I've got to show that 20 that I've provided as income on the project. How does that work in INPAG? We don't see much talk of that in the guidance itself. Yeah, I think it's going to come down really to what the agreement actually says. I think in some cases that requirement to have raised the match funding will be an EFO. That would be your enforceable EGO, enforceable grant obligation. So you're not entitled to the 80 until you've raised that 20, or perhaps it's proportionate. At that point, you would not be recognising revenue until you had demonstrated that you received the that 20, or you generated that 20 through other means. Other cases, it may be less, it may be more of a constraint. It won't be that you're not entitled to it, but if you don't raise it by the end of the project, then you would have to make some repayments. That's more of a constraint issue. So it will come down ultimately to what the wording in the grant arrangement or the agreement that you have with the donor says, whether it's strict enough to meet the criteria to be an enforceable grant arrangement, or whether it's less strict. So it's a different type of agreement that imposes constraints. So
interesting. So we could have an EGA where the obligations relate to raising match funding, and there might also be obligations in terms of what you have to do with that money. That could be quite an interesting
yeah, can
puzzle
get quite messy.
Yeah, it could get quite messy. So I
Yeah.
think that's a really interesting question that's been asked there that we need to think about. Another one that's also really common in our sector is this indirect cost contribution. So say a project is 50 and the donor's going to give 50 of direct costs, and then there's another 10%, 5, that's a contribution to indirect overheads. And I've seen the practice in many places to recognize that income differently. The 5 is recognized differently to the 50. Is that, well, how, again, INPAG doesn't really talk to that so much. How does it work in terms of recognition of income that is for overhead?
That will come down again. It's all going to come down to how the agreements are set up. If the contribution to the overheads is a separate funding stream in that agreement, then yeah, so you've got to receive that 5, no obligations as to how you use it or anything. Then you may very well treat that as need to split the agreement into 2 parts, the EGA and the OFA, and that 5 might be part of an OFA. If on the other hand we're going to pay you 55 to carry out this activity, and you know that that's going to be 50 of direct costs and 5 of indirect costs, basically you're still being paid 55 to carry out that activity. So you would recognise the whole 55 as you satisfy the obligation, carry out the activity. So it's going to depend again on what the grant arrangement says. Like many of these questions in practice, how do I deal with this? It's going to come down to the detail in the grant arrangement. Is it a separate funding stream? Is it part of the all together as a single obligation? We'll pay you 55 to do this.
I will at this point share some good news, because this came up in our webinar last week as well, that this issue of the complexity, diversity, and sometimes vagueness of grant agreements can be part of the source of the headaches when it comes to the accounting, right? And you even have whole revenue departments and arguments between finance and auditors poring over 70-page contracts that aren't even clear when you get into it. So one of the sort of side projects that we're hoping to do as Humentum is to convene funders and work on some standardized, hand-picked grant clauses. So if you want this accounting treatment, this is the kind of wording that should be in your grant. And hopefully that can be a resource that funders and NGOs can use when they're negotiating their grant terms or drafting their grant contracts, to make sure there's clarity about some of these things, because they're complicated: match funding, indirect costs, etc. So linked to that, really good question about restricted funding. So restricted funding is obviously a key factor in our sector. And so this question is about restricted funding and multi-year funding. So the question is, if I've got a restricted multi-year grant, can I just not recognise it according to the payment plan?
Again, we're going to look at what the grant terms say. So if you were to receive all of the funding up front, and well, partly it'll depend on whether it's an OFA or an EGA. If it's an EGA, you're not recognising revenue until you've carried out the activities. So if it's a multi-year grant, you're going to be recognising revenue over those multiple years anyhow, because that's when you're going to be carrying out the activities. But if we're looking at an OFA, so normally you would recognise when you control the resources. If it's a 3-year grant and you receive all of the funding in year 1, then yes, you would need to recognise that revenue in year 1, because there's no liability associated with it. Even though it's meant to cover 3 years, you've received all the funding, you can use it as you choose. So you need to recognise the revenue. It will be shown, we think, separately, restricted funds, but that's exactly how that will happen will be decided as we develop ED3 for publication middle of next year.
Right.
But many of these multi-year grants will involve the donor making payments year on year. So you'll get a payment for year one, you'll get a payment up for year two, you'll get a payment for year three. Because it's not going to be enforceable in terms of both sides having that we can enforce payment, they can enforce what the NPO has to do, then it will be treated as, well, you only control the revenue when you receive it. So in that case, you would only be recognising the revenue. We've received this amount for year one, we'll recognise it in year one. Second year, we receive additional amounts, we recognise that revenue in the second year, because you wouldn't be controlling that cash until the point at which you'd received it.
Okay.
Generally.
And I think that it's a really key, because I think in many of us, the restricted and unrestricting is the kind of key distinction that we're used to when we've kind of lived with and worked with. And here, this distinction between EGA, Enforceable Grant Agreement, and everything else isn't the same. You could have an OFA, and other funding agreement, that has some constraints or restrictions or not. So I think we need to, it does require a slight shift of language, that restriction and EGA aren't completely the same thing. And as you say, we'll be providing guidance on that in ED3. But I think the idea is that the restriction wouldn't impact on the recognition. It would impact on the presentation, right? So whether something's restricted or not doesn't impact on the recognition. The recognition is defined by whether or not it meets the criteria of being an enforceable grant obligation. And if it is, the cash flow and the recognition of income aren't the same thing. So you wouldn't necessarily recognize the income according to the payment plan. You would recognize it as the obligations are fulfilled. So that's a really good question, sort of clarification question. And there's something similar here from, I saw there's so many questions in here, it's fantastic. Oh, it's gone. Okay, is it basically that the oh no, I can't find it, so I'll ask a different one. There's so many good ones, I will find a good one here. I want to ask about assets. There's a couple of questions around assets. So Shane asked, if I've got an EGA, an Enforceable Grant Agreement, for the construction and subsequent use of an asset. So I'm going to build a maternity clinic and I've got to use it as a maternity clinic for 20 years. The video said you've got to split that into two discrete obligations, two EGOs, one for the construction and one for the use. How would you split, say it costs 100 to build this building, how would you split that 100 between construction and use? And then the second part of his question is, many NPOs would like to recognize the revenue to match the depreciation over time. So if you're depreciating that building over 20 years, can we recognize the revenue so that we don't get muddled up with our surpluses and deficits? So could you speak to that? Because that's I think that's quite a big common concern.
Yeah, I think the challenge really is what exactly is, again, we're getting back to the terms of the grant arrangement. Is it two obligations, an obligation to build the asset and an obligation to use it? And if that's the case, then there should be grant amounts that apply to each. If the grant is intended to fund the building of the asset, but not to fund any of the activities that you carried out for afterwards, then you need, there is a question there. Well, actually, have you got an EGO to build the asset and a constraint that you then must use it afterwards? So that's going to come down to the terms of the grant arrangement. If you've got an arrangement to build and use the asset, and there's no other funding for any of this, then you would expect the grant to be greater than the cost of building the asset to fund that ongoing activities. If it's not, then you need to think about whether or not actually the grant is an EGO for the construction, but actually just a constraint in terms of use. Brilliant. So that's going to come down to the questions of what the grant arrangement says again.
Okay, so maybe the use is a constraint. So it's only if you fail to use it for the right thing that you might recognise a liability.
It may be, if the cost is 100 to build it and your grant is 120, that's probably a grant. You probably then do have the two obligations: the cost of building it, the cost of providing the services afterwards. And one of the things in terms of
the split of the obligations, the second half of the question, which I think probably impacts on more people, is this. If I recognise grant revenue for a capital grant, can I then expense the asset to match it, or can I match the income with the depreciation? Is there any way to get the income and the expense in the same period, basically, which is what a lot of people want to be able to see?
In terms of direct recognition of revenue, no, because the requirements are that you recognise the revenue to match the completion of the obligations, which would be, in terms of looking at the asset side of things, it would be in terms of when you've built the asset, you would have met the obligation, so you would be recognising revenue by that point. And that goes back to the fact that, looking at the conceptual basis, you recognise revenue when you don't have any outstanding liabilities. There's no obligations after you've built the asset, therefore no liabilities, so you need to recognise the revenue. We've moved away from the idea of match funding or match accounting, which was there maybe 20 years ago, but is not a current concept in accounting. In terms of practical management, that may be something that can be done through use of reserves, or depending on the terms of the agreement, it may be still the asset itself may be restricted, so you would be holding a restricted fund for that potentially. So we'll need to see what comes out of the fund accounting side in ED3. There may be ways of presenting it so that you're showing it almost as a use of a fund or a use of a reserve to match it, but not directly through the recognition of revenue.
Okay.
So there are ways of getting similar presentation, but not exactly directly through the recognition of revenue.
And this has been part of the conversation all the way along, isn't it? But what about my surplus, my deficit, my bottom line, which is really important to many users? And I think what we're seeing here with the proposals is that there will definitely need to be a shift away from users looking at the bottom line and seeing any kind of relevant information from that one number in isolation, certainly without it being split across different funds or out of context of opening balance on funds and things like that. So this is a real massive shift, I think, in the way that some users approach financial statements. And again, you see it different in different countries. So if this is a point for you, this is definitely something for you to consider in your response and your approach to this. But we are looking at educational approaches for how we can over time shift the way that people approach financial statements, rather than coming at them with a for-profit way of reading them, which has been hard to do without the standardization. Now, there's a related question here, and again, this cash accrual. So the matching questions, like, can't we just match, or can we do accrual accounting to match? Here's the opposite side of the same flip from Rafikul in Bangladesh. Different countries use different methods of recording income, like cash basis for government purposes, for our tax, or maybe our donors need us to report on a cash basis, or even a mixed basis. How can that be achieved with this? How can we do accrual accounting in our ledgers, and then we've also got to do cash accounting for our governments and donors?
Mm-hmm. Yeah, I mean, you are still going to be reporting cash figures through the cash flow statement. So there is a requirement to produce a cash flow statement that is a cash basis, and effectively what you would need to do there is break down your cash flow statement into amounts for each fund. So you would actually probably have to or for each of the donors who requires cash information, or the governments that require cash information, then you might have to break down your cash flow statement into amounts that relate to each of those funds, each of those donors, so that you can then provide that information. So it's going to be linked to the financial statements. It's not going to be directly relating to the revenue recognition. I know this is something that's being worked on in terms of the work that's going on with our donor reference group, in terms of looking at standardized formats for reporting back to donors. So hopefully that would help in that situation. I don't know if you want to say anything about that, Sam, or...
Yeah, I will. We've got 4 minutes left, so I will say
not.
something about that very briefly, and then I'll do a poll, and then we'll close. But there's still loads of fantastic questions, so I think we'll have to keep this conversation, which is what this consultation period is about. We've got till March to keep having these conversations, so this is brilliant. So yes, an interesting announcement from September last month in the technical advisory group. It was agreed that we will be publishing a second volume, INPAG, for general purpose financial reports, and something else. The name is not yet finalized, but something like a recommended practice statement or something like that for supplementary statement for reporting on a specified group of activities, such as a grant or a project. And this has been work that's been ongoing with the donor reference group, and it builds on the work from the Money Where It Counts project back since the Grand Bargain 2015. So watch this space. We are very cognizant of this sort of challenge of general purpose reporting versus donor reporting, and how this, you know, has really shaped a lot of practice in the sector. So watch the space for that. Right, I'd love us to do a quick poll. This is oh, the poll isn't there. We won't do a poll, but I might ask it on LinkedIn. We don't have a great sense of how many grants are actually meet this strict definition criteria of being an EGA versus an OFA with or without constraints. And so we'd love to get sort of a sense from the sector about what proportion. Is this a lot of them or few of them? And one thing I just want to say, that it's not that one is better than the other. There's not that an EGA is better than an OFA. They're different vehicles for different types of relationship, but they have different accounting consequences. So let me just share my screen for the last few moments and tell you how to share your voice for the consultation. I just can't thank you enough for the level of engagement, the questions, the comments, the reflections, the observations. They are so rich and very helpful. So to share your voice, step one, go to the website, ifr4npo.org, have your say, download a response template. It's in 3 languages. You can fill out your details at the top and save it. Then over the course of the coming weeks and months, you can form your opinions about the proposals. Watch the videos like the one we saw during this webinar, read the documents themselves, attend the webinars and engage with the questions, participate in outreach events. Then as you're doing that, record your thoughts in the template as you go along. It's organized according to the sections of INPAG in order. And there is a final question at the end for anything else that you want to say or share that isn't covered in any other section. You do not have to answer everything. You don't have to provide a comment on every section. Work on what's relevant for you. And then finally, just upload it through the website before the 15th of March. But this is Exposure Draft 2. As we mentioned, Exposure Draft 3 is coming out next year, and we're still on course to publish, hopefully, depending on the feedback we get, mid-2025. If we have to completely rewrite everything, then this will take a lot longer. But hopefully with other things being equal, we'll hope to publish in mid-2025. So with that, let me say thank you, a huge thank you to Paul for all your hard work and some difficult questions I threw at you there. We will be sharing this video, obviously, with you, and we'll also share the questions that we have addressed in this webinar and also the other questions that we didn't get to, and we'll find a way of keeping the conversation going around on those as well. Thank you so much, everybody. All the best. Have a great day. See you hopefully tomorrow, later this week, or next week. All the best.